Happy Monday morning, you guys, and welcome back to Real Estate Mindset. Today is going to be your typical live where we do an economic update. We're going to take a look at the stock market. We're going to have the real estate update, mortgage update, criminal complaint update, and don't worry, everything will be chaptered. We'll also take some questions if you have any questions as well. But first things first, Mitch, good morning. How are you, sir?
Good morning. It's been an interesting couple of days hammering away on documents and answering criminal complaints and helping people with criminal complaints from across the U.S., which is pretty interesting.
Yeah.
Some of the situations in California are just crazy. You know, they have different laws there, and the taxation levels are 3 layers deep, and it includes HOA taxation and MUD and PUD and what they call ruse. It's one after another after another. It's nuts. I mean, people can't afford to pay, and that's why they're leaving.
Yeah, and you guys, I can't wait to get to that part of this video where I'm going to give you guys an update on the criminal complaints. It's been extremely popular. Holy smokes, Johnny's up early right now. Monica, big shout out to Monica. She's filled out and sent in her criminal complaint. Really appreciate you stepping up, Monica. Please make sure to share your criminal complaint with as many neighbors as possible because we want it to grow. Let's jump right in to the market update. Let me do our first timestamp. We're getting into it really early today. So let me show you guys what's going on in the market. Obviously, good morning to everyone as well. I didn't see anyone else. Good morning. Dean, there you are. There's Dean. There's Johnny again. How are you, Johnny? There's Ray. How you doing, Ray? All right, let's get started right now. And I want to show you guys kind of what's going on in the market. Starting with this right here, the 10-year mortgage rates are going to go up again. We're now at 4.5 once again. Crazy stuff going on with the longer end of the yields. Moody has downgraded the U.S. debt. It's turned the market a little bit upside down. We've been talking about this for a year, right? Year and a half-ish. And now Moody has started talking about it. Market goes sideways, whatever it is, what it is. 10-year is up 5 basis points. It got up to about 4.56. So it got up to about 8-9 basis points. That's going to impact residential mortgage rates. They're going to go up today as long as this closes up. Take a look at the VIX, you guys. VIX shot up as well. I was just thinking yesterday, Sunday, how low this thing gets, right? It's like a roller coaster ride with the volatility and the fear index. I mean, absolutely shocking. They keep forgetting. The market keeps forgetting about the volatility. So it is down though. Look at this right here. It's down 42% in 1 month, although it is up 6% in 5 days, or rather 12.5%, 13% today. So the VIX is all over the place today anyways. Here's the Dixie. So the dollar losing some ground as well. Let me keep going. Here's the market, you guys. Let's see. Are we open? We should be open now. Let me go into the US. It's not updating. So markets opening sideways. Dow is going to be down about 0.5 point, 57%. S&P 62, NASDAQ 314. So not sure why it's not updated yet. Let's take a look at what's going on in the stock market. Let me show you guys the most recent updates, most recent data. So in other words, what's going on is the uncertainty and the volatility, and the mainstream is figuring it out. They're probably going to try to bury this story like they usually try to bury these things. But the stock market today is down 250 points, while S&P 500 and NASDAQ also fall sharply, and Treasury yields surge after Moody cuts U.S. rating. But again, this should be no surprise to you guys. They're cutting the rating because of the debt. We've been talking about the debt the whole time, so it should be no surprise. Stocks open lower as Treasury yields jump, so more uncertainty in the Treasury market. Probably going to have interest rates go up throughout spring, throughout summer. Time will tell. Foreign buyers are shying away from the 30-year Treasury auctions. If there's not demand and people aren't purchasing that, then that's going to go up, right? So when people are not purchasing the Treasuries, that yield usually goes up, right? And that right now, you guys, is pretty crazy, back in the 5%. So the 30-year Treasury right now back at over 5%. Now, pressure on Treasury is likely to persist and increase after Moody's downgrade. So again, interest rates will probably go up for a little while. After Moody's downgrade, a dollar frown framework may be the best way to understand markets. Blah, 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 blah. Here's the VIX right here. VIX jumps after Moody's downgrades U.S. credit rating. Again, debt, debauchery. Moody downgrade is like the closing the barn door after the horse has bolted. And that's why these rating agencies are completely useless. We've been talking about this, again, year and a half, 2 years. So why do we need them? Why do we need this rating agency? They're reactive. They're not accurately giving us proper ratings. because the overwhelming amount of debt. Yield on the 30-year Treasury sitting solidly above 5% as U.S. stock futures point to losses. Now, let's go into this, you guys. I want to go into some inflation mechanisms so you guys kind of understand why prices are high, why they're staying high, and why we need deflation, not disinflation. Disinflation is when inflation slows down. So the fraud slows down, but the fraud is still there. We need deflation where prices go down. This is one of the mechanisms that's keeping this whole thing going right now. This is the derivatives market. This is the worldwide derivatives market. So this is outside the US as well. This is the global OTC. I can barely talk right now. OTC derivatives. Right now, you guys, the notional outstanding balance. I always want you to remember this so you understand what we're doing. We're dancing on a razor blade. The derivatives market is 720. We don't even have this much in assets. It's an impossible value, but it's $729.8 trillion. It is an impossible value right there. Now, that's derived from this, guys, $17.1 trillion, which means on average, okay, derivatives on average across the world are leveraged up 42 to 1. Okay, 42 to 1 on average. What has happened to our world? My God. So again, when I divide the 17.1 trillion into the actual notional value of 729, that's 42 to 1. How can they legally do this? You know, I could barely get a credit card when my credit was trashed back in the day. Now, let's keep going. This is also very interesting. I put this over 6 months. This is the overnight reverse repo market. So again, we're looking at mechanisms of inflation. This is kind of like an active quantitative easing or an active bank backstop, okay, the reverse repo market. Now, look at over the last 6 months. I intentionally did this to show you guys it's here to stay. This is quantitative easing. This is a form of a bailout for banks in distress. But look at it. It's pretty much stayed the same, almost exactly the same for 6 months. So it's a little bit more evident now to see how they're backstopping the banks through the reverse repurchase market. So thought you guys would like that. That's over 6 months. Now, when I widen this out to 5 years, you guys can see shot up, started going down drastically. And again, over the last 6 months, it stayed the same because that is a mechanism to backstop the banks. Let's keep going. Here's another inflation mechanism. This is the yearly deficit spending. This updated as well for April. The fiscal year goes to October. Right now, just for the year, and the year's not over, we have overspent $1 trillion. That is definitely an inflation mechanism, but that's not all. This is the outstanding debt that nobody wants to talk about except Mitch and I and a couple other people, right, Mitch? The debt. We're in a debt and fraud bubble. You guys, we're sitting at 35.46 trillion. Now, I know we've been saying that a lot. A lot of people are getting desensitized to the word trillion. That's why I have this graph. See where we came from, right? Because we're just throwing around the word trillion. We can't even fathom what $1 trillion is, but look at the debt. Absolutely shocking. The U.S. national debt, and this is over the last 100 years. Super sad to see this. Let's keep going. Another thing I want you guys to understand is the federal debt to GDP. I mean, this is absolutely shocking. We're about over where we were in World War II. And this chart, just to put some perspective, this goes back to the 1700s. You guys, this goes back to the 1700s. This is, again, this is the federal debt to GDP, just so you guys understand the bubble, the fraud bubble and the debt bubble. Really easy to see that with this. It's absolutely shocking. This is saying we're at 120%. Other forms say we're at 135%. My point in showing you guys this is we are in an everything bubble. This is another mechanism. The stock market is a mechanism of inflation because of the over leverage. Now, when we also look at the Buffett indicator, which is the market cap to GDP, you can see the bubble very, very clearly here as well. This goes back to the early 1970s. So December of 1970, you guys can see we've never been in a bubble like this. I mean, in all of the indicators, we were at 200%. Again, this is a Buffett indicator up to about 202. It's bad. This shows it very, very clearly. Okay. Inflation mechanisms, we are in a debt bubble, no matter how you dice it up. But the number one inflation mechanism is the Federal Reserve. And just to put it in perspective, look at what they did to us at lockdowns. So before lockdowns, look at this. They're kind of doing some quantitative tightening. They're rolling off assets. We get down to only almost 3.5 trillion. Lockdowns happen. We all get bamboozled overnight. Look at this. And it just keeps going up. They're saying, oh, we're going to do quantitative easing right here. They're letting stuff roll off of the balance sheet right here. And then you guys see this right there. That is a backstop quantitative easing. This is a backstop right here. This is a bank bailout. This was known as the Bank Term Funding Program. So the Fed, again, the worst by far inflation mechanisms. And just to put this in perspective, you and I may be suffering, we may be broke, but the Federal Reserve has $6.7 trillion in assets. So just put in perspective. Now, here's what's wrong with everything I just showed you. This never changed. And for the people that it did change, it didn't change a lot. This is the real, which is adjusted for inflation, household income, median household income. So it's adjusted for inflation. Everything skyrocketed. Assets, prices, payments, our food, our credit cards, everything, our houses, cars, the entire world is way more expensive right now over the last 5 years. And yet our income, unfortunately, you guys, unfortunately, has basically stayed the same. And that's why, quite frankly, a lot of these bubbles aren't sustainable. You have to have a consumer eventually, right? There's still the inflation, but eventually you have to have the consumer sustain those prices. So that's going to be our quick update right there. We'll move on to a video here in a minute, but Mitch, you are on mute right now. Couple questions. I know this is hard. Okay. What should people invest in right now? We're in an everything bubble. There's a lot of uncertainty. There is a lot of volatility. We've been saying that, but people are saying the volatility. They're saying maybe there is something wrong. What should people invest in right now for retiring? Should we be careful on the 401k? Should we still look at 401ks? What do you think at this point? What's the best thing to invest in for retirement, Mitch?
I think the first issue for those who have 401ks or pension funds is to determine what is inside of your holdings. Who's making the fees? How much are those fees? Are those fees higher than your rate of return that you're receiving on those pensions or 401ks? Things are going to get extremely difficult. And I'll touch on that shortly because I've got a memo here. But it's difficult to say what to put your money in aside from a 401k or a pension. If you have cash and you want to invest, if you are doing real estate and if you're able to buy it at a proper price, that's up to you. But you must understand that there's going to be a downdraft both on the commercial and residential side, and they're going to be severe. This is what is happening right now. It's just, you don't quite see it depending on where it is that you live. If you live in a larger city, you don't see it as fast. If you live out on the outskirts in a more rural area, you're seeing it now. So it is going to ramp up. In reality, from an investment standpoint, that's what I do for a living. And I haven't been able to find a piece of real estate but for one in North Carolina in the last 90 days that made any sense. So the straight answer to the question is real estate that's bought and paid for, a business that has no debt, or precious metals. If you can trade, that's a different story. A person who can trade and make a living, that's perfectly fine. But anything that's associated with debt, one should understand if you borrow money from a bank and that bank has counterparty risk, in other words, they made additional loans that may or may not even be on their Camel One rating, which is highly suspicious at the moment. You may be dealing with a bank that may not be there in the near future, which means your loan can be tainted. Now you have to go and fight in order to get that problem fixed. And I had that problem at one time with Colonial Bank. So Colonial Bank went broke. I had a loan there. And fortunately, we got it rescued, but a lot of other people didn't. So we wrote a check to make it go away. So the point of the matter is that you have to understand where you are and what you're investing in. And if you don't, you're making a huge mistake. And putting money in a certain amount of your portfolio in precious metals is appropriate given where we are in this economic cycle.
You know, a lot of these loans are already tainted, Mitch, because they removed debt to income ratio from qualified mortgages. I mean, there's so many loans that are tainted because they refuse to follow the safety mechanisms that were put in place to make sure that consumers were safe. They did away with all of that to keep this whole bubble and whole circus show going. Does that make you sad, Mitch? You know, looking at all this stuff, because you moved here to escape what we just showed the viewers. Does that make you sad? And when did you really wake up to the fact that this was going on here in the United States? It took me 40. I was 40 years old, and I still, I still am blown away by the debt and debauchery at the hands of our government, specifically our Federal Reserve. When did you wake up to all this nonsense?
Well, when I was in Canada, Canada is a socialist country to begin with. And so I saw these problems as a young kid. And I want to point something out that's pretty important. Fraud has a real cost. When you lose money due to fraud, somebody else took that money. Mm-hmm. And that's exactly what's happening. Fraud will creep up, as you're seeing in those charts that Travis just showed you. Fraud gets larger and larger. That's a compound cumulative interest rate on the continued debt that's being produced, a continued principal debt that's being produced. So you have fraud on the interest because the values were never real. That goes up. Well, when the bubble bursts, allegedly that all goes away. The fraudsters took the money. You, the taxpayer, ends up with nothing. Fraud has a real cost. And you're starting to see that real cost come up. It happens in inflation. It happens in the interest rate. It happens with the money that can never be paid off. In Argyle, Texas, $343,000 worth of outstanding fraudulent school district bond debt. This can never, ever, ever, never be paid off. And we've got an article coming up here that we'll go over in a minute, that if I'm wrong, I have a list of questions for the Federal Reserve. Prove it.
Yeah. Let's get that out right now. I want to go over a couple questions, but get out the Federal Reserve questionnaire, because I'm going to put that on the screen and read that in. And then we'll get into our first video on the housing market. You guys are going to freak out. This video is so bad, but it's important to understand what they're saying, because there's some top housing market analysts that are speaking about the housing market, and it's just so gut-wrenching. But here we go. So I just wanted to throw this up for Joe. They're saying my experience at Nikki for decades, my 401k underperformed. I wonder, Mitch, how much of the underperformance was a result of all of the fees that they take, right? So maybe they take 2, 3, 4, 5%, whatever it is. But how much profit or potential profit goes towards fees? Any idea what percentage that is on average?
Well, here's the problem with private equity, and private equity typically runs these funds. Private equity, for the most part, is a con. And the reason why it's a con is because mom and pop, if they were educated, could do it on their own. And the education isn't that great. If you think that these private equity guys have better education than you do, you're wrong. They don't. So let's look at it this way. It's a straight up mathematical formula. If you get 2% of assets under management, and you get 20% of the profit, but the 2% of the assets under management on $1 trillion, that's not a bad payday. Do you really care about the profit? And the answer is no. They are not on the same page as their investors. They're there to screw over the investors. And by the way, they have no mathematical ability to see into the future other than somebody who's smart and understands what volatility is, and they can take positions. But they're putting you in the flavor of the week. They're not putting you in the mathematical quant position that they should be putting you in. That's how most pension funds are run. These school teachers that have these hidden investment pools, they're dead in the water. Those pools aren't going to pay off. Those who put the fees together and are taking the money out, that's where the money is. State of Texas, the Bond Review Board. Governor Abbott sits on that Bond Review Board. He's the chairman. Why is there a $24 billion bust between that and the Texas Education Agency information in terms of the outstanding bonds? Who's getting the money? The state of Texas has what's called a bond guarantee program. Allegedly, that thing's got $57 billion worth of money, yet Can Utility School District went bankrupt. Who's getting the fees? Whoever is getting those fees, that's where the money is. That's why, to that point of that article, people don't understand. This is a fee-generating machine. It has nothing to do with making profits. They're just there to take their profits, their 2%, and they're gone. They don't give a damn whether you make money or not. That's the problem.
Well, they're salespeople on commission. They're salespeople. You guys, these analysts, these genius economists extraordinaires, they're just salesmen and women who make commission. Come on, it's the oldest trick in the book. I mean, they want to sell you, so they make money and they put food on their table and they get to continue to pay for their lease on their Mercedes, all that type of stuff. Mitch, let's move on now to your Fed questionnaire. I'm going to put that up on the screen here. Again, I got some really good videos. You guys are going to freak out on these videos, but I have this up on the screen. Oh, whoops. I took Mitch out of here. I got you back though. There you are, Mitch. I have this up on the screen and I'm going to see if I could do a better format here for you guys. There, that's a little bit better. I have this up on the screen, Mitch. Do you want to go over this form and then we'll go into our video?
Okay. So to the point of the fraud and debt bubble, that is where we are. That is what we have to live with. And if I'm wrong, this is a memo to the Federal Reserve. Prove it. So the point is that right now we're in multiple court cases, hearings, to decide to have a hearing. Now think that through for a second. These lawsuits have literally turned into a hearing to decide if we're going to have a hearing. In other words, they don't want the case heard, and they've proven that. I've created dozens of articles and charts to outline the financial crimes being committed against humanity, both via the Federal Reserve, the U.S. Treasury, and the central appraisal districts, which are owned by the school districts. The evidence is irrefutable against the central appraisal districts and the school districts. We've got all that on the website. And even in our court case, the documents state the evidence is irrefutable. Remember, it's their tapes, their transcripts, their depositions, their documents, their regulations. The evidence against them is irrefutable. The courts in the state of Texas don't want it heard. Okay, Federal Reserve. If I'm wrong, then the Federal Reserve, with your 23,000 employees, must prove that I'm wrong and create a detailed organization chart visible to public scrutiny outlining: 1, how much are the derivatives, the over-the-counter, non-exchange traded, CDS, CDL, MBS, swaps, swaptions, interest rate swaps, on and off balance sheet, outstanding at the federal institutions? What is the mark-to-market value of those derivatives? 3, what is the notional value of those derivatives? 4, how much are the bank-to-bank guarantees globally? 5, who issued the derivatives? List them. 6, who is the counterparty? List them. 7, who profits from the existence of those derivatives? 8, what is the exposure to the counterparty? 9, what is the exposure to the economy being mom and pop? 10, who bears the risk for the existence of those derivatives? 11, how much of those derivatives are held as collateral by the Fed? 12, what are the derivatives held at face value or mark to market? 13, who created the derivatives? 14, how much leverage exists per contract? 15, if that financial party went broke, what is the bail-in amount? 16, if that financial party went broke, what is the bailout amount? Let me help you. The Bureau of International Settlement, that's that link that's right there. They have the metadata. Please sort through the metadata and create the org chart and answer the questions above. More than likely, this will never happen, and the system, and I put that in quotation marks because this isn't a system. The system that's designed to defraud is a crime scene. More than likely, that crime scene will be destroyed to cover up the crimes, and the system will be blamed, and not the criminals who benefited from the crimes of the financial fraud. This section does 2 things. It proves to you, mom and pop, that they can't answer these questions. They won't answer these questions. And that is because the crimes are being committed. This also ties to another document that I wrote called the Financial Crimes Against Humanity, which lists all these things out. And that ties right back to the issue. We are in the ultimate fraud bubble. That is where we are. This has to be dealt with. There are solutions to this. Problem is, the politicians don't want to get involved, and that, at this point, leads me to believe they intend to crash the system. But they're stupid, because the crash this go around will be much worse than the Great Depression. you will end up, based on our numbers, around 35% unemployment. If they don't stop this nonsense and start walking these debts down, which is fairly easy to do, it's not that difficult. It has to be done. I mean, it's not easy, but you have to realize this is independent of the true economy. You're being asked to guarantee their debts. That's the problem. The true economy is mom and pop. You can separate that out and go after the debts on these OTC debts and start bringing them down. All these intercompany bank guarantees, intergovernmental guarantees, that stuff is all kabuki theater, and the public can't see it. And if they could, we wouldn't be having this discussion.
Well said, Mitch Wexler. I always enjoy your presentation. And you guys, to the viewers, I never know what Mitch is going to come up with. He does these masterful mind maps. I don't know if we're going to have time, Mitch, for the mind map. I did do a chapter for that. I'll upload that document in this video as well, and I really appreciate it. Now, Mitch, for this next portion of this video, and I have some really good comments. We're going to get to those comments, but just for the sake of time, I want to get into this video. You're going to need to sit down for this one, man. You're going to need to sit down. All right, I'm just going to warn you in advance, okay? No using cuss words, okay? None of that. This is going to be on the housing market demand, okay? That there's still strong demand, but we just need affordability. They're going to say all kinds of crazy things about interest rates, things like that. We'll talk about it after the video. It's about 5 minutes long, but I'm telling you guys right now, it's really, even though this is nonsense, it's really important that you understand what the talking heads at the very top indoctrinating everyone. You said it's important you understand what they're saying so that you can rebuttal it and so that you can counter it and so that you guys can be the light in other people's lives because they're not getting the truth. So if you guys can, let me know that the audio is okay and we'll get started now.
April building permits coming in a little bit lighter than expected, while housing starts did meet expectations. This after, remember, homebuilder sentiment yesterday fell this week to its lowest level in years. Joining us to talk about what's going on in the housing market is John Lovallo, UBS Homebuilders Building Products Analyst, and Logan Mohtashami, Housing Wire Lead Analyst. It's good to have both of you here. Just Logan, big picture, what's the story right now?
Homeowners need lower mortgage rates. Active completed units are back to historical high levels. Traditionally, that's typically the end of the cycle for them. As supply increases and margin pressures, they are not in a mood to start building a lot more homes. And the builder's confidence index is 4 points away from the all-time low we saw in COVID.
And yet, John, you still like these names, even though sentiment is souring and activity has been so sluggish. Why?
Look, I think the builders have done the appropriate thing, and that is to pull back on starts and not push volume out into the market, right? So they're remaining disciplined. That demand is still very strong, the underlying demand. In fact, we have a survey out, the most recent version, one of the longest standing surveys on the street. 32% of respondents want to buy a home within the next 12 months. That compares to the long-term average of 30% and the pre-COVID average of 25%. The intent to buy and the desire to buy is there. We just need affordability to get in a better place. Now, the home builders are doing the right thing, and they're buying down mortgage rates and helping along the financing. So what we need to happen is things to sort of settle politically. Consumer confidence, we saw the numbers today, that to stabilize to some extent. And then you know what? I think we're going to be in a very good position for the builders to do.
Aren't prices finally coming down, though?
Prices are pretty sticky. There's certain markets where we're seeing some adjustments. Inventory is up in certain markets. But you know what? I think that the builders, again, are executing properly, doing the right things, and that inventory will get worked down. And as we move through the end of this year and into next year, we're going to be in a really good spot for the builders and these stocks.
Logan, how low does the average mortgage rate need to be before buyers can hold their nose and spend? Does it still need to be a 5 handle?
No, you know, when mortgage rates get now near to 6%, builder sentiment improves. So the 10-year yield going lower, mortgage rates going lower, builders can sell product, except near 7% or above, it doesn't work that well for them. Again, margin pressure here, but if the 10-year yield and mortgage rates go just towards 6%, new home sales can grow, existing home sales can grow. Right now, that's the best we can have because monetary policy is not very pro-housing right now, but you don't need 3, 4, 5. Just getting down to 6% and holding that for some time can make it work for the new home sales market.
So, I mean, for so long, the swing factor, John, was inventory, right? That was what was keeping prices. And yes, mortgage rates, of course, important. What's happening there? You said that home builders are are holding back a little now.
A little bit. I mean, inventory is actually not in a bad spot outside of certain markets. Think of the I-4 corridor in Florida, think about Austin, think about Phoenix, but all those markets are starting to get a little better. I agree with Logan. I think the builders have been buying down rates to sort of between 5 and 5.5%. That's been a pretty good spot to get demand moving. And I think that, as we sort of move through the year, we're going to be in a spot where I think buyers are going to come back to the market. Now, keep in mind, this sentiment index that came out from the home builders, that's really private builders, smaller builders. They don't have the balance sheets or the access to financing that the publics do. So if you were to survey the publics, I think they would feel a little bit better.
Are you neutral on all the building products or materials because of tariffs?
Not neutral across the group. We certainly think there's opportunities. I think tariffs certainly present a risk, but also existing home sales at GFC trough levels, and that's the lock-in effect because rates did move up so quickly. The prevailing mortgage rate out there today is 4% versus the headline rate at 7%. People don't want to move. That makes it hard to do repair and remodel jobs.
There's the material cost, Logan. And sometimes if you talk to, for example, a lot of quick service restaurants, the issue of immigration and deportation and labor availability, some argue is even more important. How does that weigh versus materials and housing?
I'll always outweigh the 10-year yield over labor material costs. President Trump wants lower mortgage rates because he saw what happened during COVID. Lumber prices were 1,500. We had inflation, but lower mortgage rates, builders were able to sell homes. So this to me will always be a 10-year yield story. Mortgage rates go lower, new home sales could grow, existing home sales grow. We just do not have policy right now. If the labor market starts to get weaker, housing could perform better because the 10-year yield should go lower in that environment.
Have we gotten any compression between mortgage rates and long-term treasury yields?
It's a great question. Not yet. The average spread historically has been 170 basis points. We're probably closer to 250 today. That would certainly help if we saw some compression there.
Logan, so what's the outlook? I mean, not knowing exactly where rates are going, what do you think is going to happen to activity rest of the year?
The existing home sale market has actually had 15 straight weeks of positive year-over-year growth data. However, that's working from all-time lows. The builders, are still at 2019 levels. If the 10-year yield could just get down a little bit more, new home sales can grow, existing home sales can grow, but we've been very, very stubborn in keeping rates near 7% rather than near 6%. The 10-year yield rules everything right now. So we'll see how the rest of the year goes. Existing home sales market should perform a little bit better than the new home sale market this year.
All right. Thank you guys both.
Well, I mean, the existing market outperforms the new home market every year. A couple things I wanted to show you guys. They're both, first of all, we've had Logan on the show before, Mitch. I think he's right about how interest rates are really strangling the market. They don't ever talk about price, but here's what I want to show you. They're both like, yeah, rates, they don't need to go to 5%, just the lower sixes, and new home builders will be okay. That's what they just said. But here's the issue I have with that. Look this is Lennar right now. So this is, let me show you what they're offering. This is Lennar right now today. If you guys go to Lennar Houston, they are offering, Mitch, a 1.25%. They're offering a 1.25% and their inventory is still shooting up, which means even at 1.25%, they still can't sell enough of their houses. Now that is a temporary buy down. So it goes to 2.25, 3.25, but it stays fixed right here at 4.25. And the crazy thing, because the rate buy downs aren't enough, okay, because the prices are too high. No one wants to talk about that. They're also doing $6,000 towards closing costs and up to a $50,000 price reduction and a move-in appliance. Which, by the way, those are IPC, interested party contributions. Those are, first of all, they're exceeding the threshold of allowable IPCs. Okay, that's one. They're also not taking the seller contributions off of the appraisal value. That's number two. I could go on and on about new home builds, but my point in telling you guys all this is, what the hell are those guys? I don't know what those guys are talking about. I don't know what Logan's talking about. It is what it is. Let's keep going into our housing market update. And I'm going to sum the housing market up into basically two things. We're going to talk about price and we're going to talk about payment. So once again, here's the home price to median household income ratio. This is over the last 50 years, going back to 1975. So this is income compared to price. And you see here, anyone can see that we are in a massive price. I'm not talking about payment yet, Les. I'll get to payment, but this is price. We're in a massive price bubble. You cannot dispute that. You could say maybe the bubble's not going to pop because of whatever reason you think, but it is a bubble. And it's a bubble because this outpaced income, significantly outpaced income. But this is the price bubble right here. And it's not just the price bubble. Here's the payment. Okay, so hold on, let me let this. I love this from Zillow, to be honest with you guys. I love this because this is an affordability calculator and you can go all the way back to the year of 2000. So I'm going back to 2000 now. The advantage of me doing that is I can show you what during the global financial crisis, what the maximum debt to income ratio on average was. And you guys can see at 10% down, and you know, let me put 5% down because a lot of people want 100% financing back then. But you guys can see the debt to income ratio, or the payment for you, Les, the payment peaked July of 2006 at 43.6%. Okay. Crash happens as Plummets. And then what happens in 2022 is they removed debt to income ratio from qualified mortgage parameters. And this thing shot up. It used to be a cap of 43%. So in Dodd-Frank Wall Street Reform and Consumer Protection Act, the cap is 43%. But they removed that in 2022, and wouldn't you know it, look at the debt to income ratio. It went sky high, just like the removal, or I'm sorry, as soon as they removed that. Absolutely crazy. We've never had a period. I wish this can go back to the 70s and 80s so I can compare 70s and 80s. But again, you guys, we have a price bubble. We have a toxically high mortgage payment when compared to income. And at the same time, in here, those are, you know, we're going to sum up the housing market. Those two things plus this, okay? This is the pendulum swing. So it doesn't matter what people are saying. If inventory is going up, okay, then there's not enough demand to absorb the current and existing inventory. It is what it is. And the fact that we now have more active units than we did via lockdown, right before lockdown, means that we are almost where we were before lockdowns. And to put this in perspective, I'm going to go back. Let me see. I wrote this down right here. I'm going to go back to 2019 in April. All right. So April 2019 compared to April of 2025. So what, 5-6 years ago? We're only off. Okay. You guys see this right here. This is April 2019. You guys hear we're off 4 million properties. Okay. You hear that all the time from the National Association of Realtors. But we are only off April to April, so April 2019 to right now, 177,000 units. Not millions, not 500,000, 177,000 units to get back to where we were in 2019. Think about that for a second. Meanwhile, the prices and the payments have skyrocketed. Income has not moved at all. I mean, do you guys really think it's sustainable? Some people do. I'm going to tee up our next video here. But first, before I do that, okay, Mitch, I got a question for you. Okay. I know you invest in real estate. I've been looking for deals for 3 years. Okay. I was up last night doing two things. I was looking at real estate and I was looking at gold and silver and palladium and platinum. And that other metal that starts with an R, what is it called? The most expensive metal? What is that called?
Rhodium.
Again? What is it?
Rhodium.
Rhodium. I was like, maybe I should buy some rhodium, right?
No.
I'm just kidding. But
No
I was
platinum.
looking at how, okay,
palladium.
no, I'm not going to do it. But I was looking at houses as well last night, and I found numerous houses. I found houses, and this is what I'm kind of interested in now. I want to get a house once it's time and I find the deal of my dreams, probably a downgrade, and I want a 10-year loan. I want to do a 10-year mortgage because I can get a home for about 1,800 to 2,000 square foot, put it on a 10-year loan, and it's still less than my rent, right? 10-year loan, less than my rent. It's a house, but I have to find the deal of my dreams. Can you talk to the viewers about how important it is in real estate, especially to be patient? Because once you make a decision to buy, your purchasing power is done. It's not like you can divorce your house. Your purchasing power is shot. Can you explain how important patience in analyzing a real estate transaction is?
Unfortunately, there's a lot of people that are going to insist on buying homes right now rather than sitting still. They're not totally my concern because people want to do what they want to do. But from a standpoint of having a long-term asset, We have multiple issues, one of which is the real estate tax, which has to be eliminated. The other one of which is we are in a fraud bubble. I've lived through this. I've seen this. 2007, 2008, 2009. I saw people walking away from their houses. I saw those houses going back to the banks. Those houses were being sold at 50 cents on the dollar. And we are back to that, except on steroids, because the compound cumulative effect of the debt, as the money was printed by the Federal Reserve, plus the outstanding school district fraudulent bond debt that's now on all these houses, is going to cause a greater reduction in value. That's just, like I said, fraud has a cost. And when the fraud comes out of the system, that's when the cost is extremely well known. We can tabulate it now. That's what we've done. We know that there's over 5.1 trillion of outstanding school district fraudulent bond debt across the United States. We know what that math is, but it's going to come out of the system. And the net result of it coming out of the system is the devaluation of those homes. You'll find houses, again, back in Harris County, when all's said and done here, they're going to be selling between $65 and $85 a foot. This is what's going to happen. This is going to be a nightmare. But in order to reset and get away from this fraud, that is what's going to happen. With regard to CNBC, excuse me, CNBC has no respect for their audience because they didn't tell the truth. They're promoting what's called XHB, and that's a basket of home builders. Okay, under theory that a basket is designed to smooth out the volatility, I get it. But how can you be doing that and telling your viewers XHB is great when Lennar Homes itself, I just looked this up, they're down 40% year to date. How in the world can you possibly be saying everything is fine and the demand is there? Well, if demand is there, then Lennar stock would be through the roof. So you see, they're lying. CNBC is lying straight to your face. They polish it up, then they push it out there, but it is a straight up lie. They didn't mention inflation, no mention of the median household income. And then all those giveaways that Travis was quoting are just like the multifamily concessions. It's one and the same. It's nothing more than marketing. Hey, you walked in, you're a buyer. Let us do you a favor in order to get this sale done. Well, we're going to give you $50,000. Wait a minute. Okay, you want the cash or you want to still take the $50,000 and overpay for the house? You're getting screwed. Their marketing machine, the spit and polish at CNBC with the fancy studios and everything else, and mom and pop doesn't necessarily have the ability to see through the nonsense. They have no respect. CNBC has literally no respect for their viewers. If they did, they'd have a research team that wouldn't let these monkeys on without looking under the hood and figuring out what the true volatility is of the stocks that they're promoting and talking about. These are not good people.
They are not good people. I had some questions about what I was drinking today. It's an energy drink. I need it because I get up early. I'm also wearing an NAD Plus patch. I love those things. My God, they're so good. Let's go into our next video. This video is also wacko. This video is from Taylor Morrison. So this is... That last one wasn't bad. This one is surely bad, Mitch. This one's even worse, but it's from a new home builder. And I want you guys to pay attention because when I was listening to this, first of all, what I've been saying this whole time, three years on YouTube, I've been saying there's always going to be demand to buy a house. Everyone practically wants to buy a house. Everyone does. So there's always demand. The problem is you can't afford it. People don't even qualify right now. I'm glad they don't qualify because a lot of people would make mistakes that would get them in an even worse situation than they're already in. But there's always going to be demand on the sideline. That's nothing new. That's nothing special. And that's the thing that people get so wrong here. So we're going to listen to this video from a builder. And I want you guys to tell me in the comment section whether or not you think that she's valuable in what she's saying, or do you think that she's acting like a crackhead? I don't know how else to say it. Let me know that the audio is good. And you guys sit tight. We'll play this right now. I'm serious about the crackhead thing.
Which is actually finding pockets of growth, but does expect tariffs to hit Q4 housing starts. Joining me here is Taylor Morrison CEO, Cheryl Palmer. Cheryl, it's great to have you. You talked about sort of the cadence of the quarter. Started off weak in January, stabilized, I think you said, in February and March. I'm curious what you're seeing in April and how that compares with activity in recent years.
Yeah, you're exactly right, Sarah. Thanks for having me today. We started off a little slow in January, and I think we're up about 10% in February, and then saw another 12, 13% jump into March. April has been a little bumpy. As I said on the earnings call, Liberation Day was kind of a day that was unsettling for the consumer. There's certainly demand out there. We're seeing a lot of traffic. We're certainly seeing sales, but we're not seeing the surge that we would normally see between March and April. April would generally be a peak in the spring selling season.
Is it consumer sentiment or is it the inventories, a housing market dynamic? What is it?
I think mostly, you'll never be able to point to just one thing, Sarah, but I think mostly it's consumer sentiment, confidence. There's a lot going on out there, and they're trying to, process what does it really mean for them. I think to fully appreciate it, you almost need to dissect the different consumer groups. When we think about first-time buyers, very rate sensitive, and the volatility that we're seeing in rates has an outsized impact for.
Now, just real quick, okay? It doesn't affect only first-time home buyers. It affects anyone that lives in America that's an American citizen. Doesn't matter if you're a first-time home buyer. The prices and the payments are still absolutely crazy toxic. What is this lady talking about? Let's keep going.
This group and truly, leaning into what they can really afford. When you think about your move up, your second move up, and our resort lifestyle, maybe some call active adult, they're really focused on the macro. They've got the resources. It's not quite as much about interest rates as just how do they feel. They're making a very big purchase decision and just want to have a better understanding. So they're just taking a little longer. We're able to move them with incentives, but just taking a little longer than you would normally see in a very robust environment.
How do the tariffs impact your costs of construction and ultimately your financials?
It's such an interesting question, Sarah, because I've seen lots of predictions out there on what it means. And I don't know how we can know exactly what it means yet, because we don't know what this 90-day pause brings. When we think about what we know today, and that would be more the universal 10%, it's immaterial. It's literally a couple hundred to a few $100s a house. And that's on newer starts that really will affect the fourth quarter. So it's a rounding error. If we think about 26, if all these tariffs were to go into play, it would have a more meaningful impact. The numbers that we've initially looked at is maybe 1 to 1.5% of purchase price. But once again, we don't know if all of that's going to come into play yet.
So does that mean it will not raise prices for the consumer on homes? And what's happening overall with prices? Because, that's been part of the pain here, is that housing prices have not come down that much.
They haven't come down, but they haven't moved up materially either. And, it's always a little tricky when we talk about where are we raising prices or are we increasing incentives. So I like to look at net pricing. And once again, it's very, very not even market, submarket, community specific. I think in the last quarter, we saw net prices move up in about 30% of our communities. But I would tell you those moves are much more modest, and I think that's okay. So if tariffs were to happen today, would we be able to take all of that? Probably not. It would probably be a shared expense between the consumer and the builder.
Cheryl, when it comes to sort of the buyer right now,
Yep.
What do you think is more important? Lower rates? What's going to get them to sort of the levels you might have anticipated previously? Lower rates or a resolution sort of on the tariff side? Is one more important than the other?
Once again, without being redundant, I think it depends on who. I think confidence.
What is this lady talking about?
Effect today. I really do. I think some sort of stability and certainty on what all this macro noise means. I don't even know that 100% has to be settled. I think it's more around just some confidence that we're moving in the right direction. The level of volatility moderates. I think when you think about the first-time buyer, rates are critically important. What we are seeing is a true preference for new. I think the consumer, David, really does appreciate that there's some significant advantages if it's just that the inventory is 40 plus years old, where that inventory sits, or our ability to help customers with some of these rate buy downs, forward commitments that really help them get into a monthly payment they can afford.
A monthly payment that they can afford. I don't know if you guys caught it, but she said, our higher clients, they just don't feel like buying yet. They just see how she's pushing feelings, man. She's feelings. They want to feel good about it. This lady's absolutely psycho. She doesn't know anything that's going on. And I'm sitting back thinking, like, that's the best that Taylor Morrison has? Really? That's the best? What's more important, tariffs or interest rate? How is that even a question? The interest rates have a direct impact with obviously the demand. People are still so focused on interest rates. No one's talking about price. We're desperately trying, Mitch. But anything you want to comment on based on what that genius analyst from Taylor Morrison said?
Well, she's the CEO. She's preaching her book. I get it. But here's the problem. CNBC needs to change the name for Truth in Advertising to the Morning Shill Show. And the reality of it is that even Taylor Morrison's stock, because I'm staring straight at the chart, it's down 14% year to date. And its PE is 6.2. So Taylor Morrison, on the overall scheme of things, as compared to Lennar, could fit in the back pocket of Lennar Homes. It's a nothing. But no mention of the real estate tax in any of the communities that they're building in. No mention of the outstanding school district fraudulent bond debt that's associated with every single house that they build. Same thing for Lennar. If you're going to buy a house, you better know what these real estate taxes are. Over and above that, you have to understand that fraud has been committed for since at least 2016. You've got a compound cumulative effect of fraud. And remember, the fraud is a cost, and that cost will come out of the system one way or the other. When it does, all these values will go down. So she can say whatever she wants. She seems to be sincere in it. But the bottom line is she's not really good with analytics. That's clear.
Yeah, I mean, a lot of people are just like her, not really good at analytics. Let's go into the mortgage segment now. I got some stuff to talk about with the mortgages. So let me put my timestamp here and we will get started on residential mortgage rates right now. And here's where we're at, you guys, with residential mortgage rates. So it might hit 7 today when this updates. Let me look at the 10-year again real quick, see where we're at with that 10-year. So 10 years dropping back down. Look at that. So nice little drop back down, still above 4.5%. But this will update today. It's going to be closer to 7%. I mean, it's so close to 7% already with conventional mortgages. Remember this on the upper left, you guys, that's conventional, sitting at 6.92%. FHA is right here, sitting at 6.35%. That's a little bit lower than VA. 15-year fixed is the lowest loan option interest rate on the chart right here, sitting at 6.26%. 15 years is a really good loan to get. Let's keep going. Now, I did a video yesterday that went in a lot of detail into amortization schedules. I'm gonna show you guys a 10-year here in a minute, but just to remind you how bad these death contracts are, that's mortgage death contract, is if you get a loan amount for, first of all, I want you guys to understand how much cheaper a 15-year mortgage is. So if we get a loan amount for $324,000 at today's interest rate, but we do a 15-year loan, okay, let me show you the total payments. The total payments are $521,000. Okay, you may see that's a lot of money. Don't get me wrong, to pay back in fees for 15 years. But look at what happens when I change this to 30 years. So it goes from $521,000, and that jumps up to $769,000. So what's that? $250,000. So that jumps up about $250,000. In other words, consider getting an amortization. If you guys purchase, get it under 30 years. Now, if you can't qualify for it getting under 30 years, remember you can make extra payments to turn it into a 20-year loan by doing 2 extra payments per year. So if I paid $4,200 extra per year, I calculate this, turns it into a 20-year loan. without even refinancing. Also, don't forget this. If you refinance in the first 5 years, you guys pay back all of this interest. You guys pay back $100,000 in interest. So if you refinance, understand how filthy rich you're actually making the banks, because refinancing is very, very costly. A lot of people just don't realize that. Now, I want to show you guys this as well, because I told you at the beginning of this show that I may eventually, when I find the deal of my dreams, I'm going to downgrade. Okay, my price point was in the 400,000s, but I may purchase a house that's 200,000. Here it is here, and I may do a 10-year loan and I put about 6% interest rate. Let's change this to 6.25%. Okay, so 10-year loan. That's it, right? I feel like I could pay a house off in 10 years, right? Here's the thing that I want you guys to understand: the mortgage payment. Okay, if we downgrade, if we don't get the absolute perfect house, we could pay this off in 10 years, and this is lower than this is lower than my rent payment. My rent payment's $2,700. So if I get a home that's $200,000 on a 10-year loan, I could potentially have that cheaper than my rent. So as we get closer to the market balance and that pendulum continues to swing, Mitch and I are going to start talking more and more about techniques on how to purchase real estate. In other words, we're also going to get in the market and purchase real estate ourselves. So I want to make, remind you guys of that. Let's see here. What else do we have? Oh yeah, this was very interesting. This is purchase demand. And I went back to, excuse me, I went back to the year of 2000, because what I wanted to show you guys is it's more about the price than it is about the payment. And we know that because of the chart that you're looking at right here. And the only thing that we need to do to prove it's about price over the interest rate is let's just go back in time to when interest rates were this high. So if we go back to the, excuse me, the global financial crisis, all right, interest rates right here, it says about 6.73%. So back during the global financial crisis, we didn't have these 2-3% rates. Rates were in the 6 and 7% back in the global financial crisis. But look at the blue lines. The blue lines represent demand. Okay, so those blue lines are demand. So back during the global financial crisis, we had the same, basically, it's a little tiny higher now, but we basically had the same interest rates for years, you guys, 5 years, same interest rates we have today, and the volume still exploded. And the reason that is because the prices, the PE ratio wasn't that high until the peak of 2007, maybe 2006. My point in telling you guys this is price really, 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 really super duper, it matters. Price really matters. So that's going to be our mortgage update. I'm going to give you guys a couple tips, and then I'm going to go into the criminal complaint. Now, when it comes to your mortgage, make sure, again, some industry tips. I've been a loan officer for over 20 years, licensed residential mortgage loan officer for 20 years. When it comes to shopping for a mortgage, you're going to want to shop, and you're generally going to want to shop for the first 2 weeks to 4 weeks of when you first pull your credit, because you have a grace period on your credit profile when the first inquiry for a mortgage is ran. Usually that's 30 days. In other words, there's no harm in shopping for a mortgage. And also understand that generally you're going to get a better deal if you go with a broker versus a direct lender. The reason that is generally a broker is designed to have the lower rates, but also their overhead. So the cost for them to run their business is generally much lower, so they don't have to pass on that extra expense to you. Customer service is bad, though, generally. Now, remember, interest rates don't go up and down every day. The price goes up and down every day, not the interest rate. So you want to make sure to look at pricing. You want to shop your mortgage. Consider FHA. The disadvantage with FHA, just really one disadvantage with FHA, and that is your mortgage insurance called MIP does not go away. It will go away in 11 years if you have a 10% down payment. So if you don't have that 10% down payment, it's not going to go away. I'm going to jump into the criminal complaints right now, and I'm going to give you guys an update on those criminal complaints because we had so many people step up. My God, I have been working on criminal complaints for the last 40 hours. I think, Mitch, that's all I've been doing for 40 freaking hours. I've been using AI to track down old parties to name them in these suits. But before I get into that, do you want to comment on mortgages, maybe how one of the best investments that we can make right now is paying off our houses? Anything you want to add to the mortgage segment, Mitch?
Indirectly, yes. So price is what you pay and value is what you receive. So Travis said a key word and it just toggled something in my mind. So I went and wrote up a formula. But if you pay $350,000 for a house and your tax rate, for the sake of conversation, is 3% per year, in order for you to make a profit on that house, that would cost you, the 3% per year over 10 years would be $105,000. Your break even, if you went to sell that house, would be $105,000 plus the $350,000, taking into account the real estate taxes. In order to have a profit, you'd want, let's just say that the profit's 5%, you'd have to have $175,000 over and above all that. So your sales price in the future, 10 years from now, would need to be $630,000. What are the odds of your house that you're buying today at $350,000 selling in 10 years for $630,000? I put it at less than 5%. So that proves the point that your equity, everybody's equity, is being stripped out of these houses. There's simply no way you're going to make a profit on the sale of your house. Now, yes, it's true that everybody has to have a place to live. There's no doubt about that. But you see in 2016 or prior to 2016, that wasn't the case. The fraud started to ramp up heavily in 2016. And that formula literally proves exactly why the real estate taxes must be eliminated in favor of the uniform state sales tax. There is no reason to own a house. If you think you're going to make money on that house, you're delusional. The math doesn't stack. They're taking it from you. They're taking the rights from you to earn a profit on that house and giving it to themselves, which is the real estate tax, which goes to the school districts. And then the school districts lever up the cash flows 20-1 and go ahead and commit $5.1 trillion worth of outstanding school district fraudulent bond debt across the United States.
Okay, very good, sir. All right, guys. So this next segment, thank you, Mitch, by the way. Let me do our next timestamp here. This next segment is very, very important to the channel and to the goals of this channel, which is to make a permanent positive change in society. And that is filing the criminal complaints. Now, our last live, I specifically said, hey, if you're in Texas and you want to help us hold these crooks accountable, I need you guys, and this is right now, okay? I need you to do this right now. I need you to email me, if you're in Texas, the name of the county you live in and the name of the independent school district, okay? And I will try, I can't do this probably till the end of the week because I'm leaving tomorrow out of state, but I will fill out the criminal complaint for you guys to where the only thing you have to do is put your name, your address, and a brief description on how unaffordability has affected you. I will do all of the math for you. I will go back and I will find the parties to name. So math, all of the parties to name, and I will save all of the exhibits for you. The only thing I need you to do, again, is those three things, answer them, and walk it into your local DA and mail that to Pamela Bondi in Washington, D.C. We're not going to give up, you guys. And I wanted to show you how many people stepped up, okay? And again, I want you guys to do the same thing here. And here's where I'm keeping all of this now. If you guys go to realestatemindset.org, so here's the homepage, okay? I reorganized this. Here's the homepage. Go to the criminal complaint tab. That's up here. And I want to read the name. So if you guys are in any of these counties and school districts, you can get this right now. And I'm going to show you what's in it. But so far I've done Bexar County, which is the Alamo Heights ISD. I did Denton County, Argyle ISD, Johnson County, Godley ISD. I did Collin County for Frisco ISD. I did Fort Bend County for Fort Bend ISD. I did Ector County for Ector ISD. I did Parker County. I did Medina County for Medina Valley ISD, Bexar County, but I covered Northside ISD. And all of these I did, only one school wasn't in violation. So out of 14, I found one. I did Montgomery County, so that's in the area that I live in. I did the Harris County, which is Houston ISD. I did Carmel County and Carmel ISD, and Fort Bend, which is Lamar. Holy smokes, Lamar is huge. But I'm telling you guys that because I want you to come here and I want you to email me the county and district you live in. Now, here's what it's going to look like. So here's a criminal complaint. Let me just download one of these real quick and I'll show you guys. I don't know if I can download it because I'm in a different screen. Let's see here. And I just wanted to show you guys. It may have me log in. I wanted to show you guys what's in here. Okay, this is it all right here. This is what I've done for you. So I have the criminal complaints almost complete. I have a step-by-step. This is just going to tell you to turn it into the DA and to mail it to the Department of Justice. But look, I have the exhibit saved as well. My screen almost froze. Okay, so I have exhibit A, B, C, and D for every single one of those criminal complaints. But don't forget, you guys can also go to Mockingbird Properties. If you guys want more detailed legal ammunition, go to Mockingbird Properties, go to the DCAT on the upper right here, And Mitch has a treasure trove of legal information on how to fight property taxes and why it's illegal. But again, if you guys can, I really, please, if you can, email me immediately, and I will have my email pinned in the comment section, and I will have it in the description of this video. I need you guys, as soon as you're done listening to this, if you're in Texas, email me the county, email me the ISD. I will send that back to you via a link, and I need you guys to help us because it's spreading. So those are 13 different criminal complaints that I made from between now and our last video that we did on Friday. And some of those criminal complaints, multiple have been downloaded because I'm asking people, if we're doing all this work, please, on top of turning it into a DA, share it, you guys. We already did all that work. We uncovered the fraud. Share it with your community and let this thing spread. If it spreads, we can make a difference. If it doesn't spread, we can't make a difference. Maybe we can, but we don't have as good odds if you help us. Please, if you're in Texas, please, if you're listening to this, I don't care if you own, I don't care if you rent, email me, county, ISD. I will meet you more than halfway. I will meet you more than halfway, you guys, and I will do a lot of that work for you individually. So I'm going to put my email in the comment section right here, just so you guys have it. Mitch, anything you want to add on those criminal complaints?
There's two forms of the criminal complaint. There's a long form, which is on my website, and the short form, the more simple form, is on Travis's site. We can get through the simple form and help people in Texas much quicker than we can the long form. The long form has been signed and already sent to the DOJ, care of Pamela Bondi, U.S. Attorney General, in places such as Kansas, Florida, Ohio, Illinois, and California. And they're using the long form as a checklist. It actually works for multiple states. Obviously, some of the laws, the description of the laws, as in the codification of those laws and numbers, change. So that has to be substituted in. But the long form seems to be very applicable across the states. The short form, for the sake of Texas, gives Travis, Jeff, and I speed where we can help the individuals who need the help. Most people can handle this on their own.
Yeah, and the reason I'm doing this, guys, I want to give you the path of least resistance. I know we're all struggling. I know that we're drowning in debt, so I just wanted to make it as easy as possible. In fact, it's so easy. I'm going to show this to you once again. Let me see if I can zoom in so you guys can see it. Look at all this I've done. I mean, I'm not trying to pat myself on the back, but I'm proud, man. I'm proud. I don't get paid any money to do this. I'm only doing it for the community. I'm really proud to have done so much. But look at, it's asking for your name here, your name and address, and look, it's all done. My God, this is done. Look at, I did all the math here, guys. I identified the year of the violation. I calculated the amount of the violation. I notated the dollar amounts. Look at this. It's done for you. And most importantly, this was a little bit harder to do. I named the parties. Look, every criminal complaint has different parties. The superintendent and the school board, all of them have Glenn Hagar though. But look at, and then you go into the right side. It's just your name, your name, your name. Is this really that hard? It's not hard, guys. It's not hard to be a patriot. Here's your address, your name. And here's where like this, like give us a, we don't want them all to be the same. So tell us how it's affected you negatively. But I am willing, and so is Mitch, to help with this. All right. We're putting a lot of effort into that because we got to hold these people accountable. There's been people, Mitch, that says, oh, we told you nothing's going to get done. You just give up now. And when people say that, I roll my eyes. I'm like, how could we give up? We're never going to give up. Never. As long as we're alive, right, and healthy, we're not going to give up on this. We're just going to get stronger and figure out how to be more potent. Mitch, we're going to get him out of here. All right. Let me see if there's any questions. Okay. Here's one. I like this one. 401k makes you pick a model, aggressive, for example, or not aggressive. And they don't tell you what's in it, what's in the 401k. You have to dig to find it. But one Euro Pacific fund has nearly 3% fees. S&P is only 0.03%. So your portfolio would have to go up 10% for you guys to make 7. So remember that 3% fee, that's exactly what Mitch has been talking about this whole time. Mitch, look at this comment right here. The courts will never allow you to challenge their system. That's kind of the ruling that you got the other day. Wouldn't you agree?
No, they're not going to have any choice in the matter.
Why?
It's non-negotiable because the U.S. Supreme Court, assuming that they take the case, is going to dump all over the state of Texas for violating its own constitution. It's called the 10th Amendment to the U.S. Constitution. Point of the matter is, we live in a republic, and a republic means the laws are for all, as compared to a democracy where the majority rules. The majority does not rule. There is no rule of the majority in the United States of America. We are a republic. It is not an option not to be heard in court. First thing. Second thing is, the whole purpose of a court, anywhere, at any time on the planet, is to stop chaos. Well, if they refuse to hear it and refuse to adhere to the laws, de facto, there is no law. If there is no law, then can anybody explain to me why it is we're paying real estate tax? Here in Texas, there's millions, there's 12 million people that own houses. Why are we paying tax if there's no protection for the taxpayers? So you see, they're being fools. They're being stupid. The Fort Worth Court of Appeals could not be more wrong. They violated the law. That one clause says, generally speaking, a taxpayer can't protest against the government. The concept of what they wrote is 100% wrong. They will lose. This will be overturned. Now, we go to the Texas Supreme Court. Am I expecting the same thing? Yes, but not at the U.S. Supreme Court. The problem is that the damages, when we get to the U.S. Supreme Court against the state of Texas, are going to be in the billions. Now, again, can we collect the money? No, that's not the point. The point is there is only one solution. There is no other solution, and that is the repeal of the real estate taxes in favor of the uniform states sales tax. Or what they will do is they will blow the system to shreds intentionally to hide the crimes. The problem is that's exactly why I put this website together. The documents are fact. The documents are published. It isn't going away. It's on multiple hundreds, thousands of hard drives across the United States. That's why I put it out there. It's not going away. These people are guilty. Make no mistake. They cannot disprove the fact that they're not guilty. They don't have a defense. It's their own documents. It's their own videos. It's their own testimony in public under threat of perjury. They're caught. So the courts can buck up all they want, but this is headed, as I said from the beginning, I believe this is headed to the U.S. Supreme Court. So it's not unusual. You lose the odd battle, but you don't lose the war, because losing the war in this case is not a good thing for the United States of America. You cannot steal money from people and think you're not going to get caught. And when you do get caught and the American people wake up, best you duck.
Okay, I like that. And I have been ducking the best that I can, Mitch. It's still been very hard.
Hard for everybody.
Pigo Trading Desk, thank you for the love, brother. Thank you for the super chat, the $2. I really appreciate that. Shoot me a question too. And let's see here. Okay, we got that one. And how will the government weasel its way out of answering these questions? I mean, the last time they did, they just used a law and said, because you're a citizen and taxpayer, you don't have a right to hold the government accountable. It's pretty crazy. So, one more time, guys, please, really want to make this, really knock this out here. Let me go back here. I want to show you guys. Email me, okay? Email me the criminal complaint information, the county you live in, the ISD. This is so important to each and every one of us. You don't have to do that. You can just come to my website. There's a short version criminal complaint right here. This should work for several different states. There's a step-by-step in this. So if you don't email me, come here and do it yourself. Maybe I already filled the criminal complaint. You can find that out on the criminal complaint tab. If I've done that, it's already there for you to do. But again, please, you guys, one last time, email me, and we will do everything we can to help support your fight to eliminate fraud. And happy Monday, guys. We're going to get them out of here, Mitch. Everything is chaptered in the description. Really appreciate you guys once again. Follow the links, follow the breadcrumbs. And if you guys are out there investing in real estate, you guys already know we wish you luck and we hope you win.